All right, I hope everyone had a great lunch. Looks like everyone's perking up. Yes, heads? Okay, awesome. So thanks so much for having me here today. I'm excited to talk to you all a little bit about how you get your startup funded, current market conditions and how you should think about the timing and growth of your startup, as well as scaling into new markets. And these are all topics that we cover in tandem with lots of entrepreneurs. So I'll try to be as general as possible, but if you have specific questions, please don't hesitate to reach out at the end. So the startup growth imperative, we're going to talk about how you prepare your startup for scale. But before we get started, I always like to start with a little bit of context. For me personally, as a venture capitalist and starting off as a startup operator, I always operate from the place that I think great ideas can and do come from anywhere, and I love to challenge what I think is a preconceived archetype of what a great founder looks like. And so my first instances and experiences with entrepreneurship was actually watching my grandfather build his farming business. It's a photo of him right here, and those are some cocoa beans in front of him. If you like chocolate, that's where your chocolate comes from. And long before I knew what a tech founder was, I watched him build his farm from subsistence farming to being a major global exporter to chocolatiers in Europe. And for me, that's always been a great frame of reference because this was long before venture capital existed. People weren't investing in farming businesses. And I try to remind myself as I talk to founders through my travels that there is no single archetype of what a founder looks like, and that great ideas can and do come from anywhere. And that's a very good thing. That leads to a diversity of the businesses that people build, the products that they launch, the teams that they build, and ultimately makes for a richer founder ecosystem. And so a little bit about me. I started my career off as a startup operator. So a lot of the perspective that I'll give you is not only based on our investment and operating ethos at Techstars, but also based on lots of experience that I've had. And so you're looking at a few logos up here on the screens, and each of these startups, so 9 startups that I've worked with over the last 14 years, in that space of time, 7 of them have been acquired. 1 has gone on to IPO, which was exciting. Not all of them were venture funded. So 2 companies, in fact, were bootstrapped, Embolden and Diff. And for those that did raise, I worked with them to raise a collective of over $500 million USD across their seed through Series C rounds. And what's interesting about these logos and relevant to what we're going to talk about today is the fact that all of these businesses launched in a local market and they needed to scale, right? This was part of the imperative for growth. They took on investment dollars from various institutional funds, and the mandate for them was go seek outside growth. And as they approached new markets, what we saw in every case was that you couldn't simply approach a new market with a copy and paste approach of what worked from a sales or a product or a marketing perspective. It required true localization. And in many of these instances, we didn't have the foresight to understand that nuance. And so we stalled a bit. But ultimately, and in retrospect, we see that taking a localized approach to scale was what was really helpful. And so we'll touch on some of those examples as I go through the course of the presentation. The last thing I'll add is that a lot of the perspectives that you'll see here are not solely from high growth technology companies. In fact, one was a service-based business, one was more of a professional networking platform. And so if your business can take on venture investment, that's great, but there are no shortage of different business models that will grow and successfully scale. And currently, I've taken all of that operator experience and experience as an early stage investor and applied it to the programs that we run at Techstars and the entrepreneurs that we invest in. So at Techstars, our values, which align very closely with mine, which is why I'm with the organization today, is we believe in giving first. So constantly working with entrepreneurs who are both part of our portfolio as well as generally in the ecosystem, especially now more than ever as they encounter challenges in their growth. We believe that entrepreneurs can change the world. That is why we're in the business of investing in them. We believe that collaboration drives innovation. Great ideas can come from anywhere. That's one that resonates with me in particular. Acting with integrity, especially as we look at different crosswinds in the market. We really believe in educating founders to the best of our abilities. That way they're equipped with the right insights to help them really steward their businesses forward successfully. Treat others with respect, and then finally, we are here to start a movement, and that movement is to inspire entrepreneurship in communities across the world. And so Techstars was founded in 2016, and in that space of time, we've scaled up to operating over 200 accelerators. So as a VC firm and as an accelerator, we too are subject to that premise of scale. The total sort of portfolio market cap to date is $25 billion across the investments that we've made. There are over 5,000 founders in the Techstars network, and we work with founders from all over the world. We have some incredible founders here in Colombia as well, and throughout Latin America and the Caribbean and different regions around the world. And I believe by the last Crunchbase reporting, we were the #1 investor by volume per Crunchbase. And so big takeaways there. We work with and invest in entrepreneurs all over the world, and very often, for promising founders, we are typically on the cap table and one of the first and earliest checks in. And so if we go back one, and so the secret sauce and how we make all of that come together is through the deployment of capital, through the programs that we run, and then through our network, the connections that we're able to foster on behalf of our founders. And this creates more opportunity. This creates a great foundation for them to build their businesses and then ultimately seek scale. And so digging in a little bit of what the secret sauce is at Techstars, how we work with founders, we really break our programming down into 3 parts. And I think that's really relevant in terms of the sequence of activities that you go through as you're building your startup. So, and again, you know, we just have some stats up on the screen about what the net result of that is. But the first thing that we focus on with founders, because we know it's critical to their success, and I'm sure you've heard before that it's not often what you know, but it's who you know that helps you in life. So the first thing that we focus on is growing your network. I talk to founders a ton, and they'll often have questions about product market fit or hiring, how they think about getting their first sale, making their first $1 million, their first $10 million, $100 million, so on and so forth. And we like to say that startups are a team sport. No one does this on their own. If you ever talk to anyone who says, like, through some heroic feat of my own brilliance, I was able to achieve success, they are probably lying to you. That's not the case. And so network's really important. And so what we do is we align founders with networks of mentors and advisors that help them in very specific areas. So product development, your market fit, marketing and technology, and so on and so forth. And this is really relevant because as you're building your business, as you scale, these are all key areas that you'll need to lean in on. And it is very, very unlikely that you'll be an expert in all of them. And so the first thing that I encourage everyone to do is to sort of map out what your roster looks like, both your team members and those in your professional networks, your personal networks. What are the skills that they bring to bear that ultimately are going to help you grow? And identify what those gaps are. And so when you come to events like this, and when you work with organizations, like so many of the incredible organizations that are represented here today, you have a compass in terms of what's missing from your bench and ultimately what you need to be successful. And so this is just a quick sort of checklist of what we would think to be the highest level. These are the bases you should have covered. And so, I'm sure as you look at your specific business, depending if you're running a business-to-business software company or if you're more focused on consumer products, there might be a few other ancillary sort of areas of expertise you'd want to dig into. But the first thing is really thinking about your network. You're not activating your network all at once, but they'll be important over the course of time, and it's always better to have those relationships and lay that foundation before you need it. Then the second thing, after you've established who your network is really focused on execution. There is such thing as scaling too early. And so the way that we think about startup growth from a VC perspective is we look at it from the lens of what are the milestones that you have to hit in order for us to fund you at various junctures in your journey. So I'm sure you've heard before, here are the requirements for someone to be seed funded, Series A funded, so on and so forth. And so when we think about the framework of execution, the easiest way for us to help founders understand that prioritization is we always tie it back to what are the key metrics that you are trying to impact and improve, that illustrate to your investors and to others in your community that your business has traction, that you have momentum, and that you're growing and growing successfully. And so examples of milestones could be launching your product in market, getting to X number of customers or revenue, getting to a certain number of employees, maybe for your product team, a certain level of distribution or margin on distribution relationships. And then finally, putting those things together, the last one that you'll see here is your fundraising strategy. And I always caveat this by saying, if you don't necessarily need external investment, and it sounds a little strange coming from a venture capitalist, I would always say you give up a piece of your company in exchange for that money that you're receiving. And so the best way to scale and grow your business is with revenue. But the reason that you see your fundraising strategy as the last box on this slide is because first you've got your network, and very often your network will know experts who are funding within the spaces that you're focused on. And then you'll have the key KPIs and the tractions and the milestones codified that investors need to look at to understand the investment worthiness of your business. And so you've brought those two pieces together, and then we focus on your fundraising strategy. And very often, and there's a little bit of a formula to fundraising that we'll go through in a few different slides, but effectively, it's really about taking all of the work that you've done, your motivations for starting your business, and wrapping that into a really compelling pitch. And so it's interesting that we're talking about scaling, for a topic where we're talking about scaling your business and growing into new markets, that we're spending time talking about telling your story, but stories are powerful. You tell stories to your customers when you talk to them about why they should buy your product, what inspired you to build it, the services that you're offering, the partners that you choose. And so developing that narrative, developing that storyline is going to be very important, not only for your relationships with your customers, but also for your investors. And so once we've got those different pieces together, now you're off to the races and you're ready to fund your startup. And so there are 8 stages for startup funding. Some companies go through all of them, some go through none. And you'll see, I think, the best way to fund your startup, revenue, customer revenue over everything. And that's the most meaningful. When your customers are paying you for your product and service, that is the biggest indication of belief in what you've built. And so the different stages, we start off with your pre-seed. This is typically your earliest stage of funding. You're taking on your external capital. And for pre-seed funding, what you're trying to do is you're largely focused on research and development, trying to prove out a concept. So you identified a problem in the market, and now you want to see if it has legs and if there's an opportunity to bring a product to market that will be commercially viable. And I always like to spend a bit of time on the pre-seed rung because very often it's a very, I think, US VC-centric stage for fundraising. We know that in other international markets, there is not as wide a network of pre-seed investors. But typically, alternatives would be raising from friends and family. And again, if those networks are available to you, that's great. We know that not everyone has in their extended social circles people who can invest in their businesses. Angels, these would be high net worth individuals who are largely subject matter experts in the space that you're building in. Grants, depending on the type of business that you're building, there are combinations of public and private sector grants that are available to help fund research and development. Accelerators are incredible accelerators like Techstars, like Accelerate Columbia, Scale Up Ventures, Scale Up LATAM. And these are great places to not only help you prepare your startup to grow, give you the grooming that you need to successfully fundraise, but often these are the first checks that you're going to get into your business, right? This is the first sort of imprimatur of someone saying, this business has legs, this founder is worthy, and they're really with you on that journey through your next milestones. And then finally, customers. And as you can tell, I'm very passionate about people building their businesses on the back of customer revenue. Then once you've gotten your concept fully formed, typically you would raise your seed round to help you really secure product market fit. Product market fit, we don't often talk about it enough, right? I think very often when I talk to founders, they think the fact that they've identified a problem that exists in the marketplace is enough. Product market fit is really about how you bring together your product and your customer, and that nuance is really important because you have to make sure that your product is being sold through the channels and in the units and at the pricing and through the various outlets that your customers exist at. And so that nuance here is making sure not only do you have a product that fits the need, but the market is there and willing and ready to embrace it and is aware that it exists. Typically, you raise your Series A round when you're ready to scale, and scaling really means that you've found something that works, and now you're revving up that repeatable process over and over again. Your Series B round would help you focus on growth. And growth as we think about perhaps new products in a related line. Then you would move on to your Series C, which typically you deploy to help you enter new markets. And so a great example here would be you've built your business. Here in Colombia, you've gotten product market fit. You've scaled throughout the country, and now you're ready to enter a new market. Let's say you're ready to enter the US. You might sort of approach your Series C and use those funds to enter the US. Series D and beyond, either for pursuing new opportunities or subpar performance. We see in the market cycles now, companies are rushing to raise later stages of funding when we see that the public markets aren't as accessible for them to IPO. And somewhere in between those, we have something called bridge rounds or mezzanine funding or bridge loans, where you're not really ready to go out yet for your next price round of funding, but you still need some extra capital in. And I'll pause here, and I think this is a great way to understand as you're talking to investors, understanding what stage they invest at, what they will expect from you based on that stage. And this is a great guide as you're thinking about reaching out to investors. But I know the reality is that very often, and in my experience in working with founders from Latin America, is that we see that, in fact, they will look at new market entry opportunities, so expanding into the US, because there's not as many VC firms that focus on seed and Series A rounds here in Colombia. And so the impetus might be to expand internationally a little earlier in order to access markets for new investors. And so this is why the imperative for scale and localization as a strategy for scale is really the crux of what we'll cover. Because this is where founders either soar and do really well, or where they start to stumble a bit. And so what VCs are looking for when evaluating your startup. This all ties back into what's going to be in your pitch, how you think about your network, who's going to support the growth of your startup. When you think about the different KPIs that you want to track, effectively the best founders are able to package all of these in a really neat storyline. And so I thought this would be really helpful. Very often when you're building your business plan, you either put together a very sort of meaty document full of all of the ins and outs and nuances of your business, or you might put together an investor deck. And they're beautiful and they're informative, but the reality is we see thousands of them every week, and so we don't read through it. And so these are really like the 7 things that we're looking for. And the more that you help us distill it, the easier it is, the more likely it is that we'll take that second meeting, the more likely it is that you'll get an interview to get into that accelerator. And it's really all about how you boil down all of the nuance in your business into different digestible parts. And so the 7 T's for building your startup. Ooh, when I'm done, you got to tell me that joke. It sounded funny. So the 7 T's for what investors are looking for in your startup. First is TAM. TAM is your total addressable market. Reason TAM is important is because as an investor, if you're deploying capital, you want to know that not only is there a market for this, but there's a large enough market that I'm going to get proper returns on the capital that I'm invested in, right? So because for all of us, we have a boss that we answer to. So for investors, we have to answer to our LPs. Our LPs are the individuals who invest the money into the funds that we then deploy to entrepreneurs, and our LPs are not doing this solely out of the goodness of their hearts. They want to know that they're going to get some return on capital. And so typically the metric for TAM is a market of $1 billion. I think that's a bit of a moving target. I think the big takeaway from there is that, is it a big enough market? Are you not gonna, you can't come up with a business and say there are 50 customers and this is a venture scale business. There needs to be a large enough market for growth. The next is traction. How is your business performing? There are many different ways that you can think about traction. Founders always ask me, well, what does traction mean? What kind of traction are you looking for? And I always turn the question around on them, like, what are the indicators that you're getting from the market that let you know that you have a viable business. And so some examples of traction could be revenue that you've got from customers. If your business hasn't launched yet, it could be a wait list for products. It could be pre-orders. If you're still in beta, it could be your email marketing list. It could be your social following. Really, it's about how you tell the storyline, how you validated that you know that the market demands what it is that you're offering. The next one here is transformative. And another way of thinking about that is there a moat around your business, right? So in olden times, there were castles and there were moats that prevented other people from getting to the castle. And we often talk about businesses in the same way. If you've identified a market where there's opportunity, we need to know that there are more legs to that business beyond being a first mover. So what is it that is unique, that is non-replicable, that is the hallmark of your business, that anyone else, especially not a large corporation who identifies that you found a market, couldn't replicate it and sort of steal the floor out from under your business? The next is tech, so unique and emerging technologies and IP. I would say I put a little asterisk next to tech. Traditionally, when we think of the world of venture scalable businesses and investing, this has largely been the domain for technology businesses. VCs as a whole, we're becoming a little bit more nuanced. We understand that, in fact, some of the largest corporations in the world do not sell technology. They sell products. They sell services. And so I would say for consumer goods, what we're looking for is there something unique in what you've created, right? So are you not just importing and slightly customizing and drop shipping a product? Or for tech, is it truly defensible? Is it difficult to replicate? Is there IP? Because in fact, part of the valuation for the company will be the value we assign to the IP. Timing is really important. So why now? What is the opportunity in the market? What's the gap in the market? What is that time-bound urgency that makes now the right time to strike and build your business? And then finally, 10x. So we look for investments that will return our invested capital by 10x. Typically, if you're looking at lower returns, that's something that we would tell you either scale slower and grow with your customers, or perhaps look for traditional financing from banks. But to be in the domain of sort of venture interested investments, we're looking for 10x returns. And what you want to do is you want to sort of bundle this all into a neat sort of storyline. It's your 30-second elevator pitch. So the problem I am solving is, I am solving this problem for, I solve it by, and the reason that we know that this is working and that there's demand or that there's traction is. And if you can bundle all those things together and you understand the relevance and the stage of the investor or the partner that you're talking to, that's often enough to get us to lean in for the next stage of diligence. And the next stage of diligence is where what we call your data room, which is typically your large business plan or investment deck, comes into play, where it's really important. And that's where you start to go through this massive checklist of things that we're looking for. But I always caveat by saying start with the 7 T's first. That's really the first pass. That's what we need. We just need enough to whet the appetite to let us know that there's something of interest there. And then afterwards, this is where we get into deeper diligence. And these are all things that you either have prepared or you know how to speak to the fact that you have them, or it may be too early for them. And breaking those down. So first, product market fit. We talked about this a little bit before. Meaningfully, you can break that into your value proposition, market size, and traction. So under your value proposition, right, it's what's the problem that you're solving. So the customer specifically, customer demographics, customer location, income, so on and so forth, segmentation. Specificity, especially when you think about customer profiles, are always best. That helps us know that you understand your market, and also means that as you scale into new markets, that you know what you're looking for, you know who you're looking to sell to. Better, faster, and cheaper sometimes can be a value prop. Convenience is often king. Is your solution incremental? Does it incrementally improve a market condition or a customer pain, or is it disruptive? Do you have a platform approach? Are you focused on one product vertical? Is your sort of sales motion a push or a pull for customers? Market size, again, some ways to think about market sizing. TAM, your total addressable market. One of the things I say about TAM, though many of these are quantified, is that these are as much art as they are science. And I would think about it the same way if someone asked you an algebra problem and they said, how many, tennis balls could you fit into Medellin? And like, well, no one's going to take out a tape measure and go figure that out. But we're looking for the parameters, how you've backed yourself into that number and making sure that it holds up and that you've really put some thought into it. And so you can either come up with TAM and say we sell to this segment of the population, right? So maybe we're selling to families with 4 kids, and we know, and they make this much in income, and we know generally, in the city there are 30,000 of those families, and so that's how we've come up with our TAM. Competitor sales are also a good proxy. If you were launching a new and innovative take in an established vertical, cost savings can be another way to look at market size. The macro market, market trends, niche and platform, and then traction. So again, lots of different ways that you can think about quantifying traction. And what's most important is that, especially for earlier stages where your revenue numbers may not be as large or as impressive, what we're really looking to answer is how do we know that there's a viable business that's going to provide venture scale returns? Then after the product market fit, the next thing we have to ask ourselves is about founder and industry fit. And I'm sure if you've ever had a wonderful idea for a product that you're excited to bring to market, I don't know if anyone's ever told you this before, but I will tell you there are probably lots of other people with that same idea, some different version or flavor of it. And so the next thing that we're looking for is founder and industry fit. What is it about this founder, this founding team? What is their experience or their skills such that they are the best team for me to invest in this space that will make them successful as they go through the different milestones and pitfalls of building a business, and that they will have the credibility in the industry in which they're seeking to enter and grow. One of the reasons here is very often what we'll see is founders may reach out to an accelerator or a VC and may say, I have a great idea for this product. And perhaps the founder fit just isn't there. We believe in the idea, we don't believe in the founder. The next thing that you do as part of your diligence, even if you're going to invest, is you would do a canvas of the industry to understand who else has a similar product, who else is solving the problem, and that's how you lean in and pick your winners that you want to invest in. And so we look at team. Secret sauce is what I would say is like, what is the white space that you've identified in the market? And that means some unique insight or nugget or bit of information that you have that maybe not everyone else has clued into yet, which has given you this sort of brilliant and innovative approach to your business. And then finally, your business model. And then the last thing would be fund fit. You can have a great product and be the right founder to run that business. But if it's not a fit with the investment thesis and with the fund, you may find that, in fact, you'll get a decline or turn away. And so doing your diligence and understanding investors or your accelerators' interest areas is definitely important. And understanding if they invest both in the industry and at the stage of growth and with the milestones that you're currently targeting. And so now that you've got your idea and you've pulled together all of the important metrics to keep you and your team on pace and on the path for growth, you've gotten some traction in your market and you're doing well, and your investors are saying, and your board members and even your other team members and yourself, you're like, I think there's more opportunity in the world for what I am bringing to the world stage for my products and for my services. And so you look at international growth and you start looking at the addressable markets in different countries and the population sizes and what their disposable income is, or you're looking at the business landscape and you start sort of creating a checklist of here are the markets we'd like to expand into next. And I wish it were that easy of copying and pasting your initial strategy of what worked for you in the first market that you launched in. But there's a lot of nuance to international growth. And this is what founders often get wrong about entering new markets. And across the startups that I've worked with, as we approached expanding into international markets, there are things that we firsthand got wrong as well. And so the first thing here is we talked a bit about product market fit. New markets require revalidation of product market fit. And so I think Mark Andreessen put it best where he said being in a product market fit is really being in a good market with a product that can satisfy the market. And so you'll go back to that initial canvas that you put together, all of the assumptions about your customer, their preferences, how they buy, where they buy, what channel partners you might use for production, for distribution. And effectively, as you approach new markets, these are all hypotheses. So that revalidation process is very important. One of the things that I see that many founders do as they enter new markets is they'll say, we've got a great business in the market in which we've launched. We're going to hire a salesperson, and they're going to go out there and sell things. And when they're really successful, we'll hire a few more salespeople, and then maybe we'll open an office. And that never works. That is a surefire way to burn through money and to fail. And so revalidation of product market fit, super important. And in fact, what you'll find is that your product may need to be tweaked. Let's say you have, consumer good. Let's say you're selling perhaps delicious soup packets. And you might do research on your new market and realize that in this new market, in fact, your consumer preferences are a little different. Maybe they like things a little saltier, a little spicier. And so this is what we mean by product market fit, revalidation, localization, because we know that people are, different across different markets. And so it's really about understanding your customer profile. Same thing with business services. It could be as simple as how people purchase. Do they purchase through partners? Do they prefer a sales process? Do they prefer something transactional? These are all things to really investigate as you're preparing for a very successful market launch. And then one other thing that we see is also finding complementary market partners. So very often it can be difficult for businesses to have the presence and the credibility to successfully enter a new market on their own. And so partners in market, maybe who offer complementary services, or perhaps they're trying to expand into a market in which you already exist. Those are the sort of symbiotic relationships that can ease a lot of growing pains. And so when we talk about localization, I think it's important to pause a bit and talk a bit about the localization paradox. We know that localization is imperative. If you want to enter new markets as you seek scale, localization is very important, but that doesn't mean that there aren't bumps along the road when you think of localization. It is often a very tedious and intensive and cost and time-consuming process. And so even if you're able to gain traction in your home market, localization is not simply getting the marketing right as you're seeking to enter new markets. It's really almost, you have to think of it as building a new business all over again with a bit of a head start and maybe a few insights that made you successful the first time around. And so this is where we see the juxtaposition of scale sort of impact with localization, because it won't become immediately apparent as you're looking for that first launch into a new market. And as you launch into subsequent markets, you're going to say, this doesn't feel like scale. This feels very manual. It feels costly. It feels time intensive. And so there's a right balance between the two. And also understanding, again, when we talked about TAM, constantly looking at the indicators and the assumptions that you've used to help you understand if you've ordered your markets for expansion correctly. So very often, population and budget and income might not necessarily be your best proxy. I know very often when founders, especially D2C, so direct-to-consumer brand founders do this, they simply look at population stats and disposable income, and so they think, well, the US is great and we should expand into the US. But actually, if they look at customer similarities and preferences, it might cause them to reorder their market entry a bit more, because it requires less of a lift in expanding. And so I would sort of bucket those down specifically for the US into just 4 steps. So if you've got your startup that is humming along and working really well here in your home country, when you think of launching in markets, and very often when I talk to founders in LATAM, they say, the next place I want to grow to is in the US. The first is, again, so treating it like it's a new startup all over again. So you're identifying the problem, using that to develop your ideal customer profile. And a really important note on customer profiles is that your customer profile is not an industry, it is not a business, it's not a department, it's an individual. So the good, I would say, gauge on whether or not you've got a customer profile is like, can you put a face to the name? Can you go to LinkedIn? Can you go to Twitter? Can you go to Facebook? Can you find someone who's representative of your customer? And if you can't do that, it means that you're still a little too vague. Then once you have your customer profile, market testing is essential, so validating your assumptions. And once you've got all of those critical inputs together, then you have to develop a local mindset. So from a sales perspective, we often see, if you're selling to businesses, sales can look very different, even if they're using the same product in similar ways, but the way that they buy services, the way they buy technology from you may be different. Do they, what do budgets look like at different businesses? Do individual managers have the ability to purchase from you, or do you need to go through a procurement process? Are they prerequisites to being able to sell into different types of businesses? Are there local regulations that you need to be mindful of? And then marketing. So as your customer profile shifts, even ever so slightly, you always need to be updating your marketing to make sure that it's relevant and it's going to land. Your product, how you think about different groups using your product across markets. So all the way from instructions to ingredients to packaging, maybe tutorials on how your product is used. These are assumptions and things that you can't take for granted. You should always be taking a local approach and asking yourself, how does my product, using it, change my customers' sort of day-to-day life or activities in a meaningful way? And how do I provide ease in that process? Partnerships. Again, partnerships can be a great way for scaling your business and finding success in new markets. And maybe you didn't leverage partnerships your first time around, but I always encourage founders, especially when they're entering new markets, to explore partnerships that can be helpful. Again, individuals who have tread that water before you. And then finally, talent. Talent localization. We know that talent it's difficult around the world to find and hire and retain great people, but your talent, localized talent, will provide you with the insights that you need to be successful. They'll have experience in market, and they can also contribute to some of the inputs that you'll need to understand how your business has to localize in order to scale. And so, final words on current market conditions. I know we've spent a lot of time talking about growth and scale, and I think I'd be remiss to wrap up without adding in a little bit of what that means for businesses today. I would say over the last few market cycles, we've never had a more robust or vibrant business environment where it has been relatively easy to succeed. And there is this notion of being what do they call it? I think it's the peace versus the wartime CEO, and the shift in mentality and mindset that requires based on market conditions and how you think about structuring your business. And so as you're thinking about growth and scale, we always tell founders, have a plan B, have a conservative plan. And so as you're looking at new markets and you're weighing the benefits and the risks, the first thing I would say is that no one can predict shifts in the global economy and how bad it'll get, but you should always have your backup conservative worst case plan. So and again, the key KPIs that you're gonna monitor and measure that will tell you if conditions are rapidly deteriorating. So if our KPI for customer acquisition dips below a certain number, we've gotta go with our conservative backup plan because the market's getting a little tighter. Creating a plan for your startup survival. So if you needed to trim costs in order to conserve cash and extend your runway, where would you lean out? And again, no one likes thinking about what will have to happen in leaner times, but the most successful startups and the best CEOs are the ones that plan for the worst. Understanding the relationship between poor public market performance and the venture environment. So I spoke a little bit earlier about the fact that as investors, we get the funds that we invest from our LPs. And we see in times of market contraction, LPs can do things where we call it missing capital calls. So basically they'll commit a certain amount to the fund, and if the market's getting really tight, they might say like, oh, I'm not gonna re-up my investment that I promised you. Sorry, maybe when the market improves. And therefore that limits the pot of money that we have available to deploy. The other thing is, based on the success and traction that you've seen to date, don't assume that that will be the sort of continued trajectory for your business. Fundraising will be difficult. The metrics and the diligence and the scrutiny that you may be under from investors, that bar may be higher. And that's why on earlier slides, we looked at what are the key milestones that you hit for different rounds of fundraising. Typically, how is that capital deployed? I would say in more prosperous times, we can be a little sort of flexible and loose with those requirements. We see that we're a bit more stringent when markets contract. If you're post your Series A and pre-product market fit, you'll either need to look at bridge loans or conserving cash to make sure that you hit product market fit, because that'll be a hard and fast barometer for you raising your Series A. If your plan is to raise money over the next 6 to 12 months, you could be raising money at the peak of a market downturn. You may not. We hope that you're not. But but this means that you should have multiple different plans for sources of funding, or maybe you're not going to as aggressively double down on scale. You focus on customer acquisition and upselling into existing customer segments. And then the last bit is that if you take all of these things in total and take heed of them and you're well prepared, then there's very good likelihood that your business will grow, will scale, will be successful, will weather through any sort of bad economic storm, which we know is always momentary and fleeting because markets are cyclical. And you know that your competitors probably weren't as well prepared as you were. And so these things in sum really help edge your business forward. And so if we take all of these things in total, what I would say is that when you found a product, something that truly puts a fire in the belly, that you and your team are excited about building and launching every day, and you bring that idea, that service, that product to the world stage, the first thing to remember is that being an entrepreneur is an incredible feat of bravery. And that in of itself should be rewarded, and you should feel great about it. And the imperative to grow and scale is something that has become very popular in the world of technology and startups. But as we looked at some of my earliest interactions with what it meant to be an entrepreneur with my grandfather, who was a subsistence farmer, is that delighting your customers and bringing your product to world stage, sometimes that can be enough. Not every founder wants to take on VC funding. Not every founder necessarily wants to have high growth and high scale. Some want a lifestyle business, and that's fine too. But if that is where your ambitions lie, then it is not by luck and it's not by chance, but it's incredibly formulaic. And so all of the prerequisite steps that were laid out are things that serve you and your business really well. They help guide you and your team. They help you understand where you need to focus. And hopefully, as we've gone through the course of the presentation, there have been some areas that have been illuminated that maybe you weren't aware of, because the things that you know are just as important as the things that you don't know about your business. You can be well prepared for them and steward your business forward successfully, regardless of what current market conditions may bring. And so that sort of wraps up. I know we've covered a ton from localization strategies and scale and fundraising, but I'll pause here and see if that piqued any questions.